Okay, the screen just told me that I'm live, so you're seeing a tape of me live. So I'm with you live on tape, if that makes any sense. Getting towards the end of the semester, got to get a little goofy, I guess. Okay, chapter 8, one of the easiest chapters in the book, deals with receivables. Are we going to learn everything we ever wanted to know about receivables? Maybe, maybe not. But we're going to touch on some of them. What we've been doing so far is talking about uh, accounts receivable mainly. There are other types of receivables, could be all types of receivables, just like you can have all types of payables. Again, a receivable is something that's going to be coming to us at some future point in time, and we need to have accounts receivable and other receivables to balance entries when we're making journal entries. Uh, Generally speaking, what we've seen so far, the accounts receivable are what we use in the normal course of business. When there's a credit arrangement and it's a rather informal arrangement, just based on somebody's promise or a consideration we give them to extend credit to or give them terms or time to pay us. Uh, we could have rent receivable, we could have interest receivable, accounts receivable, notes receivable. The difference between an account receivable and a note receivable is the account receivable is in the normal course of business. It's informal, but it's a matter of convenience extended between two parties. Uh, Usually we're selling something or some type of revenue account, and we're not getting paid until a future point in time. So we're going to credit the revenue account and have to debit some type of receivable account. Again, you see the word receivable, guaranteed it's going to be an asset account, normal debit balance. A note receivable, on the other hand, may be, not maybe, but is, as the name implies, a written note that is a piece of tangible evidence that the debt of the other party to us exists. We will have them sign it. We will have a date on it. We will have an interest rate on it. And if they don't pay us, we've got a piece of paper that we can go to. I don't know if we have them in Pennsylvania small claims courts, but you can go somewhere, magistrate, or if you, I guess, Commonwealth Court of Common Pleas. And it's a lot better position to be in if you have the person's written statement that they do owe you a certain amount at a certain date. You get a mortgage for your house, or you sign a loan on your vehicle. That's a note payable. It's a written document. It has all the terms in there, and the payment amount, the term, how long it's going to last for, the interest rate, and what happens if you don't pay by make your monthly payment by the due date. They give you so many days grace period. Then after that, they charge a penalty, boost up the interest, or something like that. Oftentimes, if a customer has been buying from us on credit and we've been using accounts receivable and they get behind, we will ask them to sign a note payable, make it a formal arrangement, and again, give us a piece of a written document that gives evidence, empirical evidence, that the debt exists. If you walk into court and you have a piece of paper signed by the person you're suing for payment, that's pretty good evidence. Say, Your Honor, on such and such a date, we entered into this contract. They agreed to pay us and X number of dollars at a certain interest rate by a certain time. They haven't done it. Please order them to do so, and or work something out. And you sue them civilly, and then the court will order them to comply, and maybe even get damages over the amount they owe us. All right. It's flipped 2 pages on me. I bet I'll get good at this about the last class. Huh? Okay. So there's a couple terms, and you've heard these terms. The only thing is to get familiar with them. With the creditor who receives a receivable, the creditor will often collect cash from customer or borrower. Okay, so they're indebted to us. The debtor is the party who takes on the liability to pay us. Okay. Now on bottom of page 8.1, or maybe it's the middle, I can't tell with this electronic textbook. Three common receivables: accounts receivable, notes receivable. We just talked about them a little bit. And I said other receivables, usually corresponding with some type of interest, or I'm sorry, some type of revenue, interest payable, rental income, payable, interest receivable, rent receivable. I'm trying to think of others specific, legal fees receivable. We use accounts receivable on the adjusting entry on an exam number 2. We could have very easily just as well said legal fees receivable. Accounts receivable, again, usually short term, or note receivable, a little bit longer term, especially when you're talking loans with other parties. Okay, usually have a maturity date. And again, to classify them on the balance sheet, anything less than anything a year or less would be listed as a current asset. Anything that is going to be collected in a period over 1 year would be a long-term asset. So if you're a bank and you've lent money out to customers, either for whatever reason, and it's 12 months or less, it's a current receivable, notes receivable. Mortgages, car payments, 3 to 5 years. The first year, the current portion of long-term receivable would be a current asset. After that, it would be considered and listed on the balance sheet as a long-term asset. All right. See if I can get this to turn one page. Starting to think may not be the electronic textbook, it might be the sensitivity of the touchpad on the computer I'm using here. Internal controls over receivables. Okay. Again, you want to separate the collection of cash collecting from the accounting of receivables. A lot of you might have heard of the term. Let's see if I get it right. Lapping, Lapping, lapping. Now, we're not talking about NASCAR racing. We're not talking about swimming in a competitive swim meet. Lapping is a accounting term, business term, used when somebody in your accounts receivable department will start intercepting and directing payments to themselves, and they will use subsequent payments to cover the payment that they've stolen. And, as long as you have customers making payments, that goes on and on and on. So how do you do that? Well, again, separation of duties and a periodic inspection of what's being sold, what is your account balances and receivables, and what is your bad debt expense. We'll get to bad debts a little bit later. That's a big topic in this chapter. Something just went through my head and I forgot. Most businesses have a credit department or a credit manager, one person. They'll decide whether a customer is worthy to be extended credit. Otherwise, you make them pay cash if they're on shaky grounds financially themselves. And again, a separation of duty. You wouldn't want that person to be involved in the sales department or answering to the sales manager, because that's at odds with protecting the nature of the customers you extend credit to. Sales department want to maximize sales. Well, an easy way of doing that is to give credit to everybody who walks in the door. Unfortunately, not everybody who walks in the door is deserving of credit. You only do that to the people who have the wherewithal to pay and have a good track record of repaying it. You've seen ads all the time on TV, radio, maybe even in print media, about some of these. It became real popular about 10, 15 years ago. Get your credit report. Well, the credit department works with those things. There's three big credit agencies out there: Transamerica, Experian, and I forget the name of the third one. But they will look at your history of loans and payments and other things like your income and your assets and give you a credit score. And I mean, I've seen some of this past week. They've shifted a little bit now to, because they've saturated the market, and they're saying, hey, improve, contact us and we'll help improve your, or you may borrow at a little bit better rate. The better your credit rating, the less likelihood of you defaulting on a loan. So they'll give you a little bit better rate. If you're a high risk, or got a low credit rating, you're a high risk of payback, or you have a higher risk of default, they may charge a little bit higher interest rate to compensate for the additional risk they're taking on. So the credit department should just do that, a rate, do the research, contact the credit bureaus, and determine whether you deserve or are able to handle credit or deny you credit. The credit rating scale for individuals, I would imagine businesses, they use something very similar, if not the same system, and it varies from a reporting bureau to reporting bureau. The top is 850. I don't know if the bottom, it's got to be 200-300, maybe 400. I would imagine most people are in the 650 to 750 range. I don't know if you've ever had a credit checked into your credit rating or had it done. I know mine, our bank does it frequently because, whenever you get a mortgage, you pay for that. The bank, there's a charge by the credit bureaus, and the bank will charge you as part of the loan processing fees. And I know myself and my wife, it varies. We're different. And thankfully, we've been blessed in life, and it's quite high. But from time to time, we go up and down 10 or 15 points. Not only that, her rating and my rating are different. At one time, sometimes her rating is higher than mine, and mine sometimes is higher than hers. But again, it's just a tool that the businesses use to decide whether they should extend credit to a individual or another business. Okay. Again, you got to be careful who you have as your credit manager. They shouldn't have access to sales. They shouldn't have. Again, later on when we get to it, with bad debt expense and allowance for uncollectible accounts receivable, somebody that has access to the accounting records can really play games, because a receivable eventually has to be collected in cash, hopefully. Well, if it goes bad, you're going to, so we're going to talk about a bad debt expense and offset of receivables. But if you have an unethical person working in that department, they could, again, direct the payments coming into their own use, and they can write those accounts off. So you wouldn't see, the collection, but you would see, there'd be an explanation if you looked at the accounting records and saw, oh, that account was written off as bad debt. And, that's one way of getting rid of them. And if the person is stealing the money, they want to get rid of the account that somebody owes you money. Because eventually, like I said, it should be converted into cash, collected in cash, and deposited. And it says there in the last couple sentences on 8-3. Credit department should have no access to cash, and those who handle cash should not be in a position to grant credit to customers. If a credit department employee also handles cash, he or she could pocket the money received from the customer. The employee could label the customer's account as uncollectible, and the company will stop billing that customer. In that scenario, the employee may have covered his or her theft. Yes, using the accounting records to cover up the trail that would lead to them. Okay, recording sales on credit. We've seen this before. Now, here's a twist. The big announcement. Pay attention here. I hope you're paying attention, but pay a little extra attention, I guess I should say. What we have seen so far from day one, when we talked accounts receivable, we are talking a master account or a control account. What that number is that we've been using is the sum of all the individual accounts receivable. A business should have an account receivable for everybody they deal with on credit. Years ago, the stores had just about any major department store had their own credit card. And then gradually, as MasterCard, Visa, Discover, Diners Club, American Express got more and more popular, they did away with it, saved the expense of having that function, and just use the contracted companies with these various other credit card companies. And each of those cards, if you have a credit card, you have a number on it, account number. And that's a unique number to that account. And that's how they keep track of it. They have one for everybody who is extended credit. So from this point on, when we talk accounts receivable, we got to say, hey, are we talking about the individual receivable or the master control account? Let me get my whiteboard up here and try to show what we're talking about here. Let me see if I have my thinner ones here. Hopefully these aren't dried out. So we have the master account up here, account receivable, and let's say it's $10,000. Well, over here in what we would call a subsidiary accounts ledger, subsidiary ledger, $10. Bear with me here. I'm almost done. All right, so there we have it. Here is the master account, the control account, if you will, accounts receivable, balance $10,000. Let's say we have 10 customers. I don't want to make up names, so I just gave them numbers, 1, 2, 3, 4, 5, 6, 7, 8, 9. Each of them has $1,000 that they owe us. So the individual account for each customer, the total of the individual accounts is what's shown over here. So it's $1,000 each, 10 of them, $10,000. Master control account is what we see on the balance sheet. Each individual one is the subsidiary ledger. These are where we're going to actually be doing debits and credits to this, and then periodically at the end of the month or whenever we're doing financial statements, with computers, electronic computerized accounting system, it does it instantaneously. When there's a change here, there's going to be a change here, whether it's increase. So say somebody pays us $500. Another one, $400 is $900, and this one pays us $100. When the money comes in, the money goes up to the treasurer. The remittance advice that you put in with your check, that you get your bill, you tear it at the perforation, put your check and send it into the company. The check goes up to the treasurer. Remittance advice, that little thing that you tear off at the perforation, goes down to the accounting department. They're going to post it to the respective accounts. So what do we have here now? 1,000. So we would have a 500, 400, 900, 100. So you'd have $1,000 credit there. So now the balance is 9,000. So the collective amount here is now 9,000. It has to agree with the master account at all times. Boy, don't I write pretty. Okay, put that down for a second here. And so you can see on page 8-3 there, they're now identifying the individual accounts receivable. And that's where the action takes place. That master control account, that just gets updated periodically once, or you can do it continuously if you've got a computerized system. If it's a manual system, might do it daily, might do it weekly. So in that tan box there, we now see accounts receivable dash Brown. Okay, a customer named Brown. We sell $5,000 worth. Have performed services on account, and then we sold them some goods for Smith. So Brown and Smith, those are the individual accounts receivable there, both on August 8th. Okay, so the control account would have to be increased that August 8th if those are the only two transactions. The control account would also be increased $15,000 to reflect the activity in the individual accounts. Okay, these separate customer accounts receivable are called subsidiary accounts, and they're found in a subsidiary ledger, a collection of all the accounts receivable. Again, think about MasterCard, Visa, and a lot of them are pegged to a certain bank. They have tens of thousands, hundreds of thousands, millions of customers. How do they keep track of them? Well, clearly they're computerized, but when you use your credit card, they know you've made a purchase, and they set up a receivable that you have to have payments that comes on your monthly bill. You send in a bill, you pay it off in full or part, and if you're paying off in part, you are paying 18 to 24%. I always try to pay your credit card off in full or as much as you can. In fact, if anyone out there in the sound of my voice is a little bit high on their credit cards, I'd advise you, there's a fellow on WILK at nights. I don't know what nights, if he's every night or just some nights. He has several books out there too. He's a debt counselor. The name is Dave Ramsey. He has several books out. He has developed a system for people that are in debt, and he stresses the importance of paying cash. If you have to charge something, ask yourself, do you really need it? Again, I'm a little contrarian. I pretty much live my wife and myself off our credit cards, but we pay it in full each and every month. All right, because the interest is unbearable. If you look at it, the minimum payment, and that's how they make their money. They charge so much interest on it. You make the minimum payments, it's going to take you 30, 40, 50 years or more to pay off the balance with no new activity on the card. So yeah, never make the minimum balance. Well, he's got a system called the debt snowball, where you, I forget if you attack the largest one or smallest one first, and one by one you get rid of them. You apply all the money you possibly can towards reducing that. And he actually has people calling the show, and it's remarkable that people have paid off $20, $30, $40, $50, $60,000 of debt in 2 or 3 years. And then they have a little celebration on air. I'm debt free, and they light some firecrackers or something, or a drum roll. Okay. So there they show you got 2 accounts receivable, Brown and Smith, $5,000, $10,000 respectively, in the control account. Accounts receivable that we see on the balance sheet total $15,000. Then they show you when they collect money, $4,000 from Brown, $8,000 from Smith. The cash comes in. They credit the individual subsidiary accounts for Brown and the one for Smith, and it'll show their balance in the subsidiary account. Brown now still owes $1,000. They paid $4,000 on the 5. Smith, she paid $8,000 on the 10,000 code. She has a balance of 3, so the control account will have a balance of 3. And you can see the total of the credits in the subsidiary accounts equal the total of the credit in the control account, and the balances agree. 3,000 in the control or master account, 1,000 and 2,000 in the subsidiaries. So we have 3,000 on both documents, or both. The subsidiary account is a detail. Each and every customer. The control account is a summary, if you want to think of it that way. Decreasing collection time and risk credit. Again, the credit cards, businesses use them because it has been shown that people will buy more when they don't have to pay for it in cash. They might move up to a better, good, better, best, depending on whatever product we're selling. And credit cards companies take the risk of collection. They do the billing, so they get paid. And we saw that in, trying to think, was that last chapter? Where they usually work on around, average around 4 or 5%. Debit card's a little bit different because it's an automatic withdrawal from the person's checking account. We don't have the thing, but if a business needs, again, this affects cash flow because the credit card company is going to reimburse the merchant on a weekly or bi-weekly or maybe monthly basis, depending on how much of a volume they do. So if a finance company of some sort and turn over, sell the receivables. The receivables are assets, and like any other asset, that you have control of it, so it's yours. You can sell it if you want. The thing is, when you're selling it to a financial intermediary, they are not going to pay full price for it because they have to wait for payment from the customer. So you have to pay for that, and it's time value of money comes in. Okay, $1 today is worth $1 more than $1 received a month from now because you've got it now. You can invest it and you get a return on it. Plus, inflation is eating away the payment you're going to get a month from now. So there's two ways you can do it. Factoring, which is just a weird name or alternate way of saying selling. And pledging is when you pledge it as collateral on a loan. So the difference is in factoring, you're selling the asset. You're giving up the right to collect the money from that customer, and you're selling it to somebody else. And they will then be, the customer would be told, hey, that your receivable has been sold to this company, please make payment to them. And from now on, and it's been nice doing business with you. Pledging is you go to the financial intermediary and you pledge the receivables for cash as a loan. You pledge it as collateral on a loan, thereby reducing the risk of default, and you can get a little bit lower interest rate. So when pledging, I don't know if our book gets into it here, but when you factor it or when you sell it, you can do it with recourse or without recourse. With recourse means that if the party that bought that receivable, if they don't get paid by the person that owes the amount, they can come back after the seller to be made whole. That's with recourse. Okay. Without recourse is the buyer of the receivable is accepting the risk of non-payment. Okay. And again, that's logical. Recourse. Well, what happens if they don't pay me with this thing? This receivable you just sold me. Well, you come back and I'll buy it back from you, literally. There are companies out there. A lot of them are law firms, and it's a big business. After a receivable goes past 90 days, it's very little chance of it being recovered. And collection agencies, a lot of them, law firms, will buy these up for pennies on the dollar. Okay, so I'll pay $5 or $6 for a $100 receivable, and if I can collect just one or two of them, I can make some big money. It's a risky business, and again, it has I don't say shady business, but it has a bad reputation for harassing the customers, so much so that they actually have federal laws in place now that can only call you X number of times a week or a month, and they can't harass you by calling you at work, and they can't harass you by calling you at midnight. Yeah, that's how bad that business got to be, and actually had to have some government intervention to make it a little bit easier on the person that owed the amount, the debtor, because they were really taking advantage of them. And again, our friends, the lawyers, they can be pretty harassing when they want to. They're threatening people. I'm going to come and take your car. I'm going to come kick you out of your house, repossession, all this stuff. So that covers that topic. Let's see what's next, if I can get the page to turn. Yay! Like I said, towards the end of the semester, I'm starting getting good at this. How are uncollectible uncollectible accounted for when using the direct write-off method. Um, there's two ways to account for uncollectible accounts receivable. And I'll have this in the highlights also for you guys, and it should be pretty much covered in the PowerPoints. I'm going to put up the first one, the preferred method, the allowance method. And then we have the direct write-off method. We're going to put a check up here, and we're going to put an X down here, we're going to put a smiley face up here. And down here, we're going to put a frowning face. Maybe it'll help you remember it. Okay, there we have the allowance method. You can see the happy smiling face and the check mark by the number 1. And number 2 is the direct write-off method, and there's an X there and a face that is frowning. Now, what are those two methods? Well, the preferred method, and the only one that complies with a GAAP, generally accepted accounting principles, is the allowance method. We'll talk about that after we get rid of the direct write-off method. I have a little bit of a problem with this. It's in every textbook. And if it's not GAAP, why introduce it? Well, because a lot of small businesses use the direct write-off method, okay? Not every business has to follow GAAP. They should, but they don't have to, okay? Direct write-off method is more accurate because it waits till an account goes bad, a specific customer doesn't pay, then we write it off, okay? Now, the thing is, it's more accurate, but what happens is if it's a 2 or 3 year deal, you're writing it off 2 or 3 years after you made the sale. So there's a mismatch in revenues here, and then the expense 2 or 3 years later. So we've corrupted, or we violated the matching concept, okay? So they say selling on account brings both the benefit and the cost. Benefit is potential increase in sales and profits by making sales to a wider range of customers and selling more product to those customers. The cost, however, is that some customers do not pay, creating an uncollectible receivable. They could have, whether it's an individual or business we're selling to, they could have cash flow problems. They could have had a fire, natural disaster. All of a sudden, their cash flow is disrupted for whatever reason. An individual gets sick, loses their job. What happens? Unfortunate instances like that, they can't pay. Okay, so there's two methods: direct write-off method and the allowance method. The direct write-off method, again, it's used by small non-public companies, because they don't have to follow GAAP, and they wait for it to go bad, and then they write it off. All you do is debit bad debt expense and credit the account receivable, whatever customer it is. Here they use a customer, Dan King. Okay, I don't know him. $200, can't pay, so they write off. They recognize the expense, bad debt expense, $200, and then they reduce the receivable from Dan King, get rid of it, and they credit it for $200, just as if he had paid it. But instead of getting an asset, now we're incurring an expense, getting debited. All right. Once it's written off, they stop pursuing it. Some companies accounts over to an attorney or other collection agency to recover some of the cash. I talked about that a few minutes ago, and they don't expect to recover it. If the collection agency, when they say they turn it over, I think what they really mean to say is it's sold. Try and get something out of it. Something is better than nothing. And then, how successful a collection agency is, that's, depends on how good they do their job. Okay, let me show you the, if an account is written off and the person somehow gets back on their feet, or the business we're dealing with gets an insurance claim, or gets operating again and their cash flow returns to normal, they may, if they're a moral, upstanding person, recognize that they still are obligated to pay you. And first thing you have to do, if you debit cash where's the credit going to go? You've written that account off, so there's no place to put the debit. So the first thing you have to do when somebody pays you for an account that's been written off, under either method, you're going to have to first reestablish the account receivable. Establish the fact that they still owe you money. So what you do is just reverse the account. You just reverse the entry that wrote the account off in the first place. So you can see on September 10th, they reestablished accounts receivable for Dan King for the $200 he owes them, and you reduce the bad debt expense to reinstate previously written off account. No problem. And then you pick up the debit to cash, and you reduce the receivable as if it was happening back when it was first owed. In order to keep accurate records about the collection of cash for previously written off accounts, the business should reestablish the account receivable by debiting the receivable account, and then they can record the receipt. Okay, in that little bubble there. All right, please bear with me. I've been kind of lucky here on a roll. Let's turn the page. Oh, okay. Again, limitation of the direct write-off method. Well, it's not a limitation. It's actually a violation of GAAP by the direct write-off method. Only used by small companies. It violates the matching principle. That is why it's not GAAP compliant. Okay. Matching principle requires that the expense of uncollectible accounts be matched with the related revenue. So how do we do that? Let me scroll down here. Yeah, I can turn pages, but I'm having trouble scrolling. Come on. Okay. It looks like I'm going to have to turn the page again. Okay. That's another thing I don't like about the ebook. I can't see the whole page. I can only see like 2 or 3 paragraphs at a time. Uncollectible accounts accounted for using the allowance method. Well, what we're going to do is we do oftentimes in accounting, we're going to estimate the amount of bad debt expense. We're going to estimate the amount of receivables that are going to be uncollectible, and we're going to set it up in the same period as the sales. So we're going to lose a little accuracy, but we're going to preserve the matching concept. Again, that shows you how important the matching concept is, so we get a better measure of income. Okay. So there's various ways you can estimate the. Just turned over on me. I'm going to scroll down and it changed the page. We're going to use an account called bad debt expense, and that's going to be the debit. The credit is going to be for an offsetting a contra asset account that's going to modify the control account or master account accounts receivable. It's going to be allowance for doubtful accounts. Sometimes it's called allowance for bad debts. Either one. So allowance for doubtful accounts or allowance for uncollectible accounts. Sometimes I've seen allowance for bad debts also used. It always starts with the word allowance. And what that's going to do, let me get my handy dandy whiteboard up here. So now in the general ledger and on the balance sheet, or in the notes of the balance sheet, we're going to have the control account, accounts receivable up here, followed immediately by a modifying account called allowance for uncollectible accounts. Just got some of my nice marker on my finger. Here's the master or control account, accounts receivable. Here's the allowance, right? Follows it right in the general ledger. It'll follow it in all the times we do a trial balance. Okay, these two accounts are linked. This is the asset. This is a contra asset. Sometimes they call it a valuation account. Okay, so we're going to have a balance. I don't know what the book uses. Okay, they say they've got $4,400 in their receivables, And again, that could be 44 people that owe $100 each. It could be 2 people that owe $2,200 each. We don't know. Again, you'd have the subsidiary accounts receivable here for each customer, and that would be 4,400. And they say $80 of it is going to be, they estimate is going to be uncollectible. So again, here's all the individual accounts totaling 4,400, and they estimate, and we'll get into how they figure this number out shortly. So now you look at the two of those things, and the net amount, net realizable amount, would be $4,320. Okay. We don't want to over, and we want to recognize the debt, the expense in the year those credit sales were made. Let me get up to speed here in the textbook. They say, oh, okay, in the book here, they say the allowance for bad debt account is a contra asset. It is subtracted from the asset accounts receivable on the company's balance sheet. Contra asset account. So it's going to have a normal credit balance. It can, and we'll see this in the exercises when we get to them on Wednesday or Thursday night. Depending on the method we're using to estimate the bad debt expense, and again, this has come down in about 10 or 15 minutes, we'll get there, determines how we do the entry. The entry is pretty stock. It's a debit to bad debt expense with a credit to uncollectible accounts or uncollectible receivables, whatever we're going to name it. And allowance for bad debts, the textbook uses. And again, that is a contra asset account, so it doesn't get closed out in the closing process. It carries forward from one year to the next. So the balance is going to expand and contract with the balance of receivables expanding and contracting, and the incidence of sometimes we have to adjust it if the economy goes south. Okay. Companies estimate bad debt expense at the end of the period. Well, monthly, quarterly, or yearly, at least yearly. And then we have to adjust that account. And again, the allowance account has to be adjusted. Sometimes in one method, it is the calculation, the estimate will tell us what the bad debt expense for the year is. The other two methods, there's three methods, we are aiming for a target balance in the allowance account. The combination of those two things are called the net realizable value of the receivables. And that's what it's a good rule. One of the things in accounting with the conservatism principle is we never want to overstate assets. That's why we're doing this. If we didn't estimate the amount of uncollectible accounts receivable, we would end up overstating assets because we know sooner or later somebody's not going to pay us. Okay. So they show you there how it's showed on the balance sheet. Accounts receivable, $4,400, less the allowance for bad debt, $80. Net amount, net realizable value, $4,320. Okay. Ethics, should uncollectible accounts be underestimated? Well, that's conservatives. No, they should be estimated as accurately as possible. Okay. Again, people may manipulate it, and if it's an estimate, management can be tempted to manipulate it. And again, what does management want to do? Overstate assets? No. Yeah, that's the pressure on them to make the company look stronger. But if they make it look stronger than it really is, they're doing a disservice to the people that are depending on using the financial statements to make decisions. So it's important that the accounts receivable be reported at the appropriate amount. Okay, accurate estimate is essential, and you don't want to give misleading information. Again, very rarely are we going to be 100% accurate, but we should try to be as accurate as possible. Okay, the allowance method. Again, the entries are really easy, straightforward. It's just looking at what we want to do here. Bad debt expense is not debited when a company writes off a receivable because we've already recognized the bad debt. When the receivable, when an account receivable is written off as they show on page 810, in that tan box, you can see the allowance for bad debts. The allowance for bad debts is debited, and the account receivable that's being written off, it's identified specifically which customer isn't paying, is credited. That gets rid of the bad debt. So think about what's happening here. If we get rid of a receivable that we know is bad, we have to, the master account is dropping. The allowance account also has to be reduced, because if not, this allowance is now modifying the master account that has had a bad debt, a bad account written off. Now, you might say, well, what about the expense? The expense was already taken care of when we established the allowance. Bad debt expense is an expense account, will get closed out in the closing process at the end of the year. The allowance does not. It continues on. But if we have a specific account go bad, we're going to reduce the master, we're going to write it off in the subsidiary account. It's going to in turn reduce the master control account. We have to do a equal adjustment to the allowance account. Otherwise, the allowance account is modifying something greater than the master account. I hope you understood that. Well, you'll see it better when we go through the exercises, short exercises and exercises. Okay, the entry to write off a receivable reduces the allowance for bad debt accounts and also the accounts receivable. Okay, but it does not affect the net realizable value shown on the balance sheet, because both allowance for bad debt, the contra asset account, and the accounts receivable and asset account were reduced by the amount of the specific account written off. Okay, so they show you that there. They dropped that 80, let's see. Okay, Brown or King was it? I forget who we're dealing with here. Sean Clark, okay. For example, on January 10, 2026, Smart Touch Learning determines that it cannot collect the total of $25 from Sean Clark. Okay, they made a sale to him on a credit. So they write that off. The allowance for bad debt valuation account, contra account is reduced by $25, as is the accounts receivable subsidiary account for Clark, which in turn reduces the master control account, accounts receivable, by also $25. So they show you what happens there. That $4,400 drops by 25. The allowance for bad debt drops by 25. Now drop down a little bit lower and see what happens. When it was at the full amount, $4,400, which included Clark's receivable, and the allowance was $80, the net realizable value is $4,320. When we take Clark's account and write it off, we remove it to the subsidiary ledger. It's taken off. The master account also is reduced by $25. But when we reduce the allowance for the amount of Clark's receivable, $55, look what happens. The net realizable value is the same, $4,320. Pretty neat, pretty nifty. That, I don't know, was it 14th or 15th or 16th century monk Pacelli, when he designed the system, is pretty wily guy. Recovery accounts privilege written off. Again, just like the direct write-off method, you have to reestablish the account receivable, the original receivable, and you do that by reversing the entry that wrote it off. You can see there in the example, Clark is put on the books for $25, account receivable from Clark for $25. The allowance is re-upped for $25. Then we get the cash, $25, and credit Clark's receivable for $25. And that has to be done before you post, the reestablishment of the receivable from Clark or from the customer, whoever it is, should be done first. So you have a place to pick up the credit that goes along with the debit to cash when the payment comes in. Comparison of recording transactions for uncollectibles using direct write-off versus allowance. Look at that Exhibit 8.1. It's pretty self-explanatory. It'll take you 20, 30 seconds to glance over that, review it. And they give you a little ditty here about Amazon reported accounts receivable of $16,677 million. So what is that? That's $16,677,000,000. What do these represent? And they said their receivables of customers were $9.4 billion. Vendor receivables were $3.2. Sellers were $710. Yeah. Being a public company, they have to follow GAAP, so they use the allowance method, and doesn't say what their allowance is, but I would imagine it's kind of hefty. And again, we're going to momentarily into the three methods. Two of the methods deal with the viewpoint from the income statement, a viewpoint, and one is from the balance sheet. Or do I have a reversed here? Let me just go. I'm sorry. One of them is the income statement approach, and two are what we call balance sheet approaches. So the percent of sales, they're the bullets listed on page 812 there, after the intro paragraph. Again, these are only estimates, but they're pretty good estimates because we base it on prior experience, prior history with our customers that we sell to on credit. The percent of sales, we work up a percent of our sales that do not get collected. Okay, income statement approach, kind of easy to do. The percent of receivables, again, we know for every $100,000 we're going to collect $97,000, so we know that approximately on average 3% of our receivables go uncollectible. So the percent of sales and the percent of receivables both work it out as a percentage. The only thing is one is a percentage of an income statement account sales, and again, we'd only use credit sales, not cash sales would not be included in that computation. The other one is a percentage, but it's a percentage based on the balance in the accounts receivable, which is a balance sheet account. Finally, the third one, aging of receivables, that's a balance sheet approach. It takes our receivable balance from our master control account. Actually, it works with the individual accounts receivable in the subsidiary ledger. And what an aging is, we'll divide. In fact, there's a chart or table, schedule, whatever you want to call it, on the next page or two, where it'll show the receivables 0 to 30 days. How many are current? If we have a 30-day credit term, we want our customers to pay us within 30 days. And again, we might offer them credit, 210 net 30. So anything that is current is going to be shown in the first column, 0 to 30. Then we're going to take 31 days to 60 days, and those are past due, but they're only slightly past due. Then we're going to take 61 to 90 days, and those are going to be a little bit longer past, a little bit more past due. And then we're going to just lump everything into over 90 days. Usually over 90 days, chances are you're not going to collect it. Now, each one of those categories are going to have different percentages or different rate of collectability with them. And they'll show us a thing here. They say percent of sales, compute bad debt expense. See, when you're using the percent of sales method, the computation is going to tell you what the bad debt expense is. So then the allowance for bad debt is going to be credited with the same number. So here they tell us that it's been determined that 0.5% of net credit sales are going to go bad. Net credit sales for the year total 60,000. So 60,000 times 0.5% is $300. That's the bad debt expense. The debit to bad debt expense, credit to allowance for bad debt. Now and again, these estimates, we can't peg it with any specific customer. If we knew a specific customer was going to pay us, we wouldn't have sold to them on credit. We would have made them pay cash. Okay. So that allowance, when we're doing the allowance method, it pertains to the total. We don't know which particular customer is going to go bad. Like I said, if we had that knowledge, we wouldn't sell to them. We'd make them pay cash. Okay. When we're using a percent of receivables method or the balance sheet approach, what it's going to do, it's going to give us the target, the desired balance in the allowance account. So then we have to figure out what the bad debt expense is, to get that desired or target balance in the uncollectible account. The allowance for uncollectible accounts. Okay. First balance sheet approach is a percent of receivables method. In the percent of receivables method, the business once again determines a percentage of uncollectible accounts based on past experience. This method is different than the percent of sales method because it multiplies the percentage by the ending unadjusted balance in the accounts receivable account instead of by net credit sales. The calculation for bad debt expense under the percent of receivables method is a two-step process. First, the company determines the target balance of the allowance for bad debts. Then it uses that target balance to determine the amount of bad debt expense. So what you want in the allowance account, and then look at the balance in that allowance account and see how much you need to get amount. And every now and then, it could be a debit. Okay. They give you an example there. Step one, determine the balance. They say it's a percent of the ending balance of receivable, and then determine the amount of bad debt expense by evaluating the allowance account. Okay. They give you an example there. Say the company's target balance is $255. They say 4% of our receivables balance. Okay. So next we look and we see the allowance for bad debt account has a balance of $55 in it. Okay. So if we want that balance to be $255, we have to increase it by $200. So bad debt expense will be debited for $200, and the allowance for bad debt will be credited. And there's the entry right there underneath that on page 815. Bad debt expense, $200 debit, allowance for bad debt, $200 credit. Okay, after you post that, you have the desired or target balance in the allowance account. Okay. Preceding example, Smart Touch Learning had an unadjusted credit balance in the allowance account. If a company has a debit balance before the adjustment, then you have to add it. They show you an example there. We have a $150 debit balance. That could be because we've written off an account or two or three. Okay. And they say in this case, we have $40,000 of receivables. We think 2% are going to go uncollected. So 2% of 40,000 would be 800,000. That's our desired target balance. We have 150 debit balance in that allowance account. So we have to increase it by $950 to get to the target balance. So our bad debt expense will be $950 debit, and the allowance for bad debt will also be a $950, but on the credit side. Okay, there they show you the entry. Aging of receivables, okay. Similar thing, but we're going to break it down. How long a receivable has been outstanding. Okay, there's been a lot of work on this, and it varies a little bit, the percentages company to company, and depending on your customer base and the overall health of the economy. As you can expect, when the economy gets into recession, receivables are going to go up. When things are good, the percentage of bad debts it's going to decrease. Maybe I'll show it here. I have a blank page. Let's see. My exhibit 8-2 is missing here. Huh. I apologize for that. I'm not going to be able to walk you through it. But I'm sure you'll see a thing that's set up with each individual customer's account receivable listed down the left-hand side. And as I said, across the top, you're going to have 0 to 30, which is your current. Then you're going to have 30 to 60, or 31 to 60, 61 to 90, and then over 90 with all the amounts in there. And then you'll know from past history how much of is uncollectible in each of those categories. Current, 0 to 30, slightly past due, 31 to 60, a little bit more past due, 61 to 90, over 90, way past due. Chances are you're not going to see it collected. Okay, so again, aging of receivables, same thing. You have to determine the target balance and then figure out how much you have to increase or decrease that allowance account with the offset going to bad debt expense. Okay, so they needed $130, so the bad debt expense gets a debit of $130. The allowance for bad debt gets a credit for $130. Trying to turn the page again, and it did. So they give a comparison of the income statement approach versus the balance sheet approaches. Okay. Let's say percent of sales, or the aging of receivables. When you're doing the percent of sales, the computation is a one-step process. It's going to tell you what the bad debt expense debit's going to be. Okay. Using either of the balance sheet approaches, it's going to tell you, the computation is going to tell you what your balance in the allowance account needs to be. And then you're going to have to look at the balance of that account before you do the adjustment and see what you have to do with it to get to that desired or target balance. That's the tricky part in this. And that's why I said it's one of the easiest chapters in the book, because if you keep that straight, that's the only thing that you could say, hey, that's a little bit hard or difficult. Not really. Balance sheet approach, it's going to give you the target amount. You have to increase or decrease it accordingly. And the increase or decrease will be a debit or credit to bad debt expense. And allowance for uncollectibles or allowance for bad debts. How are notes receivable accounted for? Well, no biggie there. It's an asset. Somebody owes you money, and they sign a note. It's an asset. Debit accounts or debit note receivable. And either credit the accounts receivable if you're replacing a receivable, informal, non-written debt or credit from a debt from a creditor, with a written one, and you're just taking it from one place on the balance sheet, putting it a little bit lower, and now you have a nice piece of paper that's more easily enforceable. A couple of items we have here: the promissory notes, the elements. You have the promissory note itself, which is a note to pay a specified amount of money at a particular future date, usually with interest. The maker of the note, the debtor, it's the person who owes us the money. Payee, that's the creditor, the person that the money is coming to. Principal, the amount involved. Interest, if it exists, and it usually has interest. Revenue, okay, so the one thing is you have principal and interest. Principal is the amount they owe you. Interest is to compensate us for the delay in receiving that money. Interest period it'll be on the note. It's from the date of the note, the origination date of the note, to the maturity date of the note. Maturity date is the date they have to pay it on. The origination date is the date they sign the note. Maturity date, also called the due date. Maturity value is the principal plus the interest. So we have a note here, and Exhibit 8-4. Principal amount, $1,000. Origination date, September 30th, 2025. For fair value received, I promise to pay to the order of Smart Touch Learning. They're the payee. The payor is Lauren Holland, $1,000. And there's no interest. Oh, there is 6% interest on here. And she has to pay on or before September 30th, 2026. Okay, that's when the interest ends on the maturity date. So 6% interest, she'd have to pay $1,060. Okay, so we would record the note receivable as a note receivable debit of $1,000. We're giving her a loan, so we credit cash $1,000. That's the origination of the note of the loan. And they show you, they should have used the same example here, but they go to a different example for a 6-month note to show you how to calculate the interest. Interest is done on a daily basis on this 180-day note. They count the number of days, and then you just prorate it for the number of days, because interest rates are always stated as annual amount rates. So if you have less than a year, you have to prorate that. So getting back to the one with Lauren Holland, the $1,000 times 6%, and it's for a full year, so they use 12/12 or 1. So 6% times 1,000 is $60. So when the note mature, Lauren Holland has to give Smart Touch Learning $1,000 to pay back the amount of the loan and $60 interest. So Smart Touch Learning would debit cash for $1,060, credit note payable for the $1,000, the principal amount, with the difference of $60 going to an account called, guess what? Interest income, because they're getting the interest. Now they show you if it's 9/12, 9-month note, it'd be 9/12 of that amount. They use $2,000, 10%. So 10% of 2,000 would be $200. 9/12 of that would be $150. Okay. Again, they just show you another computation there. Sometimes it's computed using a 360-day year. Yeah. Why do that? I don't know. Rather than 365-day, they use it rounding. It's going to make a couple cents difference. I guess it makes the math easier, but you got calculators. Everybody has a phone. There's a calculator function in the phone. Accruing interest. Now, that Smart Touch Learning went from September, whatever, I forget if it was September 1st or September 30th, 1 year to the next year. So at December 31st, some of that interest, some of that $60 interest that Lauren Holland's going to pay us, some is in for 2024 and some is for 2025. So we have to do an adjusting entry to record the interest receivable and the interest revenue to get it in for September, October, November, December, and then the rest would be on when the payment is made on the maturity date. Some of it will be a debit to cash, some of it will be a debit to interest receivable, and then the interest income will only be for 2026. So here they show, okay, so September 30th through December. So we don't count September because it's the end of September, so it's October, November, December, 3 months. We know the interest is $60, so 3/12 is 60, 12 into 60 is 5. 3 times that is $15. I can do that in my head. So there's our adjusting entry, interest receivable, interest revenue. That gets the revenue into 2025 and establishes the fact that we're going to have a receivable coming at September 30th of 2026. They show you there on a timeline the $45 for 2026 for the 9 months, January 1 through September 30th, and from September 30th, 2025 to December 31, 2025 is $15 interest. The 15 and the 45 add up to 60, the total interest. It shows you how much is for 2025, how much is for 2026. It's kind of a neat thing. So here's the entry for the payment. Cash comes in for the full amount, principal plus interest, $1,060. $1,000 credit to reduce the receivable because she has paid us. $15 interest receivable to cancel out the receivable established in the adjusting entry at December 31. What happened to that interest revenue? That gets closed out in the closing process. Remember, expenses and revenues get closed out. And then the $45 is interest revenue for 2026, January 1 through September 30th. They have another one here. Some companies sell household appliances and they have a finance program. So we have to record the sale revenue and then we have to record the interest at the end of the year as an adjusting entry. Okay. They show you the entries for that. Bear with me while I turn the page. Recording a dishonored note receivable. So we have a accounts receivable there, or a note receivable. Then it becomes an account receivable until we write it off. Okay. It doesn't make the debt go away. The only thing that makes the debt go away is when we write it off. And it could be due because of customer filing bankruptcy. Okay, asset test ratio, accounts receivable, turnover days, receivable, day sales are receivable. All right. The acid test or quick ratio. This is a modification of something we learned earlier this semester called the current ratio. It's a measure of liquidity, but it's a stricter measure of liquidity because if you remember, the current ratio was current liabilities, current assets divided by current liabilities. And we'd like to see 1.5 or higher, meaning you have $1.50 in current assets for every dollar we have in current liabilities. With the acid test or quick ratio, the same name for different things, it eliminates some of the current assets that aren't as liquid. In fact, we're only going to use cash and cash equivalents, short-term investments. So obviously inventory and prepaid items and office supply calculation here. Okay. So what is an acceptable asset test ratio? Depends on the industry. In general, they say 1.00 or $1 in these restricted current assets for every dollar in liabilities, current liabilities. It's a little bit stricter. That's why the ratio is a little bit lower. For the current ratio is 1.5 here. We're happy to see 1. Again, the higher the number, the more liquid, the more capable a company is of meeting its current liabilities with the reduced current assets. I shouldn't say reduced current assets. With the select current assets. Accounts receivable turnover, net credit sales divided by average net accounts receivable, average net accounts receivable. Take the beginning of year balance, end of year balance, divide by 2. Some companies will take the ending monthly balance, divide by 12. If that's a seasonal business, gives you a little bit better measure. The book doesn't get into that. I just added in for your benefit. So it tells you how many times a year you're collecting your average receivables, okay? The higher the ratio, the faster the cash collection. So I don't know, they're using Kohl's here or Amazon. Excuse me, I have to do something. I'll be right back. Pardon the interruption. I beg your forgiveness. Okay, so the higher the number, it means you're collecting your average receivables more during the year. So 12 would be once a month. 15, this is a little bit faster than once a month. 24 would be twice a month. Okay, so now just like we had a couple of the other ones with the turnover and the days sales. It's another measure of how quickly we are collecting our receivables. Is the day sales in receivables, which is 365 days divided by the turnover ratio. It's a measure of the same thing, but using a different unit. This tells us 23 days. Now, when we had that number before on the other one, the turnover ratio was 15 point something. I said that's a little bit quicker than once a month. Well, 23 days is less than a month. So I proved right. I think that about does it. Again, companies use this to figure out if the credit should be loosened or tightened up. and how they are doing. And some of this stuff is, how good is the collection department, how good is the credit manager, credit department doing their job. Um, it helps gauge that. Are we too liberal with our credit policies, or are we too tight with our credit policies? That's how the practical application of that would be. And that concludes it. And again, I'm sorry I had that phone call come in, but you know, uh, I guess I should do the break in the middle, but I have no control over when phone calls come in. Okay. Again, later on this week, I'll get out YouTube that'll go over the solutions for the end of chapter assignments for chapter 8. So see you then.